Know these 5 things when making an S election. You need to determine your reasonable compensation, figure out your starting basis, know how you can pay yourself, you need to keep distributions in line with equity, and you need to know the greater than 2% shareholder rules. Those are the top 5 things you need to know as an S Corp owner. Determining your reasonable compensation. The IRS has provided some guidance on this in Fact Sheet 2008-25. So in this fact sheet, they say there are no specific guidelines for reasonable compensation in the code or regulations. However, various courts have ruled on this issue, and based on their determinations on the facts and circumstances in each case. Meaning, these are all the factors they consider, but know that reasonable compensation for you is not necessarily the same as reasonable compensation for another owner, even if the other owner is in the same line of business as you. Let's go over some of the factors that the courts have considered. Training and experience. Do you have the knowledge and expertise to carry out this activity at a high level or run this business at a high level? The more training and experience you have, the higher they expect your comp to be. Duties and responsibilities. This is an important one. You need to split up your time since you're wearing so many hats as a business owner. How much time are you spending doing administrative tasks? How much time are you spending on sales and marketing? How much time are you spending actually just running the business? And how much time are you spending functioning as an employee in production if you still fulfill those roles? Time and effort devoted to the business. If you have multiple businesses, you may not be devoting 100% of your time to this business. Compensation is based on all these factors plus the amount of time you devote to this business. If you're only working 50% in this business because you have 3 other businesses, your compensation is likely going to be lower. Payments to non-shareholder employees. Again, this is in line with your duties and responsibilities. If you're paying your employees $70,000 to do a job, and you spend 80% of your time doing that same job, and you're paid $20,000, the IRS might flag that as unreasonably low compensation. What comparable businesses pay for similar services? This is somewhat in line to payments to non-shareholder employees. They're just trying to make sure that your compensation is in line with what the compensation is for that role in your specific area. So a lot of business owners miss this. It's not just, taking national statistics for certain occupations. You need to go to your specific locality. If you live in Eugene, Oregon, you're trying to find Eugene, Oregon wages for a similar role to determine what your wages should be. Compensation agreements and the use of a formula to determine compensation. And that is what we do as tax professionals. We take all of these factors into consideration. We develop some kind of formula based on your training and experience, your job duties, how many employees you have, how much you're paying them for those roles. All of these factors get aggregated and result in this reasonable compensation number. And this number typically changes year over year. And it usually gets higher the higher your business income is. That's because you spend more time doing higher level, higher value activities, such as managing and running your business, as opposed to functioning purely as an employee. Determine your starting basis. So when you make the switch from a single member LLC to an S Corp, because you have to have an LLC set up in order to make an S election. So if you do not have an LLC set up, it's July 3rd right now. If you set one up and you want to make a retroactive S election to the beginning of the year, you will be limited to the date the LLC was incorporated. There's a box on the 2553 and it asks for this date. And the reason why is because you cannot backdate the S Corp to a previous date before the LLC was incorporated. So what happens when you convert from a single member LLC or a multi-member LLC, if you have other partners or owners, you are going to take the total equity in the equity section of your balance sheet and allocate it to the owners. If you're a 100% owner and you have $10,000 in equity, your starting basis is $10,000. Basis allows you to deduct business expenses. If you have negative basis, you may pay taxes on excess distributions or you may miss out on business deductions. Negative basis issues typically happen when you're an S Corp with a lot of debt. So if you're a business that's leveraging capital heavily, it may make more sense for you to be a partnership rather than an S Corp. I've seen this happen many times. Business owners make an S election, they're unaware of the tax consequences of having large amounts of debt in an S Corp. They come to me, and we have to evaluate whether an S Corp is the right structure for them or whether we should revoke our S election. Number 3 is know how to pay yourself. There are 2 main ways you can pay yourself as an S Corp owner: wages and distributions. Wages are going to be ran as payroll. In the state of Oregon, you have to run payroll every month. Federally, there are no rules as far as the frequency of payroll goes. However, if you have employees, you are likely going to be running payroll monthly or even bi-weekly, depending on your circumstances. Distributions are simply you transferring money from the business bank account to your personal bank account. If you are a sole owner, you can take distributions when you have the cash. Unless you're leveraging significant debt, then you should work with your accountant to make sure that you are paying off that debt instead of taking distributions, so that you keep your basis above zero so you can deduct all your business expenses while also not running into any excess distribution problems. Point number 4 is keeping distributions in line with equity. Now, if there are multiple owners of an S Corp and they are all unrelated, I typically recommend that you create a distribution schedule to either have quarterly or monthly distributions for each owner, and make sure that those distribution amounts are in line with their equity. Know that your wages have nothing to do with your total compensation as far as equity goes. Your distributions are going to determine, your equity is going to determine how much you get to take in distributions. So if you have 2 owners and each of them own 50% of the business, and one owner takes $25,000 in distributions, you must also take $25,000 in distributions. Otherwise, you are going to be allocated $25,000 in distributions. The courts have ruled many times that equal distributions need to be stated in governing documents, but if in reality equal distributions do not exist, they should still be allocated as such, which means your basis will be reduced by distributions that you did not take. It will also create an unfair compensation arrangement where one owner gets compensated more than the other. Now, yes, you can raise or lower other owner wages to account for the loss in distributions. However, you want to keep your reasonable compensation as low as possible while still being reasonable, because you're paying the employer and the employee portion of FICA taxes on those wages. The primary advantage of an S Corp is that you are no longer paying FICA taxes on your net income. You're only paying those double FICA taxes on your wages, which is why you want to keep your distributions as high as possible while keeping your reasonable compensation as low as possible, but still being reasonable. This helps to keep the peace between owners so that nobody feels like they're not making as much as they should with respect to how much the other partners are making. The final thing you need to know, and most people miss this or don't understand it at all, and has massive payroll tax implications, is the greater than 2% shareholder rules. So as an S-Corp owner, you need to watch out for some taxable fringe benefits that are tax-free for employees that own less than 2% of the business, but can be taxable to owners that own more than 2% of the business. A few examples of these taxable fringe benefits are personal use of business vehicles. This is going to be taxable to both employees and owners. So, as a sole proprietorship or a single member LLC taxes a sole proprietorship, you likely had a business vehicle booked to the business and you were taking the home office deduction through the business because there were no taxable fringe benefit rules. Now that you're an S-Corp, you have to take those deductions differently. You take them through accountable plan reimbursements. So instead of taking the deduction on your tax return, you're actually going to take the deduction throughout the year by calculating the business use of personal assets and reimbursing yourself for those real actual expenses that occurred, which means no depreciation for the home office, no depreciation for auto, unless you're using that vehicle 100% for business. And in that scenario, I would recommend you actually just book the vehicle to the business and run actual expenses. However, for small business owners that don't require work vehicles, most of the time they're claiming mileage. And that means they're sometimes using that same vehicle to get groceries, run errands, or you may even have commuting miles if your home office doesn't qualify as your principal place of business. And with that comes taxable fringe benefits as an S-Corp owner, which is why you need to track your mileage, submit at least quarterly a mileage report to your CPA or accountant, and they will tell you how much to reimburse based on the standard mileage rate that the IRS provides every year, and each year this changes. It's adjusted for inflation. For the home office, typically what I do is I take your expenses from the prior year, I use that to create a quarterly distribution schedule, and then we true up the expenses in the final quarter so that they match exactly what was paid for the year. The reason why there's differences year over year is because insurance typically goes up every year, taxes typically go up, and then interest expense typically goes down. So every year you need to be working with your CPA or accountant to recalculate what your home office deduction is going to look like and reimburse accordingly based on actual expenses. If you found this video helpful at all, please give it a like, comment if you have any questions below, and I'm happy to answer them. You can also visit our website for more information if you're looking for a proactive CPA that specializes in accounting, tax planning, tax preparation, and fractional CFO services if your business has 1.5 million or more in revenue and you're looking to grow and scale beyond that.